Well, welcome everyone to another episode of Talk Money with me. We have two incredibly special guests that I can't wait to hear every single thing they have to say. I will introduce them in just a couple of minutes here. If it's the first time that you've joined us, welcome. We're so delighted to have you here. We will have an opportunity to answer some of your questions, so get those in. My amazing general manager, Maroki Tong, is behind the scenes navigating those questions. If you're a little financially shy, you can direct message us on Facebook or send us an email, and she'll make sure to get those questions in. All of the resources today, there's going to be so much incredible information. After we're done, we're going to put all of those resources up on my blog at kelleykeen.com/blog. You will see a picture of myself and Kelley and David from this talk, and below you can find all the information on them and what we're talking about today. So we're really excited to have you. As we speak, the finance minister and the minister of education is talking about extending CERB because what that will be. There's so many Canadians that have had a really incredibly difficult time with their finances before the crisis and then piling on with it. So we're going to talk about today about how, our brain is a little hardwired for some faulty decision-making strategies, if you will. We're wired for instant gratification. And when you have stress, the cognitive load, your ability to make decisions or even deal with things like mortgage deferrals can be incredibly difficult. So our two guests today are going to help reduce that financial friction and figure out how we can navigate moving forward, and if there is a second wave. So without further ado, I would like to introduce our two guests. First, Kelley Peters. She is the CEO and co-founder of BEworks. And Kelley co-founded that with renowned behavioral psychologists Dan Ariely and Nina Nazar in 2010. And Dan has a number of incredible books out there, and Kelley's is coming out soon too. I can't wait to read that. She's got extensive experience in the field of behavioral science, leading a portfolio, and we're going to talk about what that actually means. Leading a portfolio of hundreds of experiments that BE has projects around the world solving the financial challenges of decision-making, health, and happiness, the most important things in the world. She's developed the BEworks method, which is a proprietary framework for how to drive marketing innovation and organizational transformation. She frequently speaks about the value of behavioral insights and scientific thinking to business leaders and policymakers. In addition to serving as a visiting lecturer at Cornell, Harvard, and Boston University, she's also on the faculty of the Rotman School of Management at the University of Toronto. No slacker there. Also, our other guest, who's also not a slacker, is David Lewis. He's the Chief Client Officer at BEworks, and David promotes the application of behavioral economics to solve organizations' most challenging problems. He earned his PhD in marketing from Lazarus School of Business Economics at Wilfrid University. He also has his MBA in finance from the Schulich Business School, and he's also a chartered financial analyst. I mean, these two are going to help us solve our financial problems today. And before joining BEworks, he was also the assistant professor at the Ted Rogers School of Retail Management at Ryerson, and he's had a number of positions in the banking industry and just brings a world of breadth of experience for us today. So thank you both so much for joining us today on this Talk Money with me.
Oh, what a joy to be here. I really appreciate the opportunity to be on this podcast and to have the opportunity to share our insights with your audience that obviously cares so passionately about how we're making our financial decisions. So it's a joy to be here with you, Kelley, and with the audience that you've cultivated.
Thanks, Kelley. And David, we're going to throw it over to you first. We have it up on the blog. The number of mortgage deferrals, credit card deferrals. You've coined the term that winter is coming. Can you talk to us about some of the challenges? Yeah, both of you have some of the challenges that are on the horizon for Canadians.
Yeah, Kelley and I started talking about this back in February and March, particularly just thinking about financial decision making. And it's something we at BEworks have been talking about for a couple of years, that many consumers really just aren't making the best financial decisions. And Kelley, I know, based on the work you've done, you're intimately familiar with all of that. And, we just kept struggling saying, how can we get people to make better decisions? It's complex, it's risky, it's consequential. It's not fun to think about, though. But Kelley and I were thinking about it, and as COVID hit and then the mortgage deferrals, we literally started thinking, and of course the reference to Game of Thrones is that, a small number of people saw this looming disaster, and yet everyone else seemed oblivious to it. And as we thought about it, we thought about the long-term consequences of both mortgage deferral and credit card deferral. And those aren't really immediately apparent. A couple of months ago, the biggest problem people had was trying to find toilet paper. So they weren't really thinking about, the long-term consequences of deferrals. And the reality is a lot of people can't make their payments now. So for them, deferrals are absolutely necessary. But what many also don't realize is that interest is accruing. So it's building up. So that means your credit card balance is growing and your mortgage balance is growing. And you may say, well, that's fine. When everything's over, I'll be able to pay it off and everything will be okay. But there's other consequences that people may not be aware of. Many people in mortgages in Canada have high loan to value, which means that, the value of equity in their home is relatively low and the value of the mortgage is relatively high. And there are limits to how high that can get. Once you get over 80%, you actually start to pay insurance on your mortgage. And again, people may not be aware of how much that is, but it's the equivalent of your mortgage rate going up 2.8 to 4%, depending. And that can significantly increase your payment to the point that it's no longer affordable, because there's two other things that are necessary to qualify for a mortgage, and that's gross debt service ratio or total debt service ratio. So gross debt service ratio is your principal interest payment on your mortgage, plus taxes, plus heat. That could be up to 39%, but CMHC has recently lowered it to 35%. And then there's also total debt service ratio. So that's your principal interest, tax, and heat, plus your other debt. And that was recently lowered as well from 44 to 42. And as your mortgage balance grows, it means your loan to value is getting worse, your GDSR is getting worse, and your TDS is getting worse. So what can happen to some of these people without realizing is when they go to renew their mortgage, they won't qualify for the mortgage. They can actually lose their house. So although the mortgage deferral can help them make payments for 6 months, they may put themselves into a situation where when it comes time to renew the mortgage, they can't actually qualify for the mortgage. So, even if they resume payments, the increase in the loan to value, GDSR, TDSR is such that they no longer qualify. And that's a really catastrophic event that it's complicated, and a lot of people may not be thinking about it. As well, even if it's just a credit card, that interest is being capitalized, which means that your outstanding balance is increasing, which means that the interest you're paying on that outstanding balance is increasing. And this sort of short-term program to help people during COVID can get people through that COVID, but maybe creating a situation that is really catastrophic in the end. And what people should be doing with that payment holiday is they should be saving it. They should be reducing discretionary expenses, all of those things to put them in a better position. So our fear was that many people aren't thinking about the long-term consequences and aren't actually saving that payment to set themselves up. It's like a company in reorganization. The idea is to reorganize the business so that at the end of it, you're viable. And if people aren't doing that, it's going to, that was why we said winter is coming.
And why do you think that is, David? Why do you think that these deferrals were so attractive to consumers and that they really, as you and Kelley have said, saw it as a debt holiday?
Yeah, at BEworks, we study the behavioral biases that lead us to sometimes draw erroneous conclusions and not behave perfectly rationally as we should. Kelley can talk about some and I can talk about some, but one of the things that I think is most relevant right now is something, and this is in the research, a lot of research has been done on this. So for example, they looked at sugarcane farmers, and sugarcane farmers, they have income once a year. And during the remainder of the year, their resources dwindle until they're able to sell the crop. And when they looked at those people, their decision-making actually declined as their resources declined. And it was the equivalent of about a 10% decrease in IQ. And that sounds bizarre, but it is real. When resources seem scarce, and it's not just money, it's everything. There was shortages of all kinds of consumer goods, and that's resource scarcity. There's a shortage of personal interaction, that's resource scarcity. And what that causes is really attention on sort of your personal situation, not the bigger picture. It causes something called present bias, which is us thinking about today and not tomorrow. As I mentioned, tax cognition. It's demonstrated that people are less able to absorb and process complex information. And if you think about LTV, TDSR, GDSR, all of those, that's complex information. And even at the best of times, it's difficult to understand. In scarcity mindset, it's even that much more difficult. And there's also a lot of trade-off thinking. People sort of focus on the costs and not the benefits. And all of those things can lead people to make a decision to defer payments when in a different mindset, they wouldn't do that.
Yeah, that's really powerful. Kelley, so David was just talking about present bias. What are some other biases that are impacting consumers who have chosen to defer their mortgages and other payments? What do you think?
Yeah, I think one of the things that we need to talk about is the impact that uncertainty has on decision making. So I just want to build on David's point. We're used to thinking about scarcity from the perspective of things like, toilet paper, as David pointed out. And I just want to make sure that the listener understands that the other kind of scarcity that we're facing is this cognitive energy. We're mentally exhausted. We're mentally exhausted right now by the way we're having to work. This video channel is very, very exhausting. There's some great research coming out on Zoom fatigue. We're exhausted by the uncertainty of the information that we're getting from scientists about how COVID-19 is going to affect us, our society, and our economy. So that scarcity is something that we need to respect, is something that is a deficit in the amount of mental energy that we have. But we have to recognize the impact that it has on our decision making and the quality of the choices that we're making. We're more vulnerable now than ever to be impulsive in our decision making. And I know that people who watch your show are generally going to be people who are more thoughtful about personal finance. We do have a bit of a selection, bias happening here with this audience. But we still need to keep in mind that we are all vulnerable from the perspective of quality decision making because of this experience of cognitive fatigue in the face of uncertainty. With that impact on the quality of our decision making, then when we get back into looking at financial trade-offs, so not only are we not necessarily processing the information as David laid out for us, David laid out the changes in the financial ratios when it comes to credit decisions. So he said we're not going to be able to understand those things very well, not only because they're complex anyways, but we're exhausted kind of trying to process this information. The next thing that we're worried about is that even when we do understand these things, and some people are more knowledgeable about personal finance than others, and some are more interested in this kind of thing than others. But even if we understand, the next thing that we need to deal with, and the bankers that support us, is the quality of the decisions that we're making, the quality of our trade-offs are not as good as they ought to be. And this is what was concerning David and I, was that we have some people who have no choice but to get whatever assistance is possibly available to them. We have so many of our friends and members of our family and in our community who have lost their jobs or reduced employment, or their businesses are just hanging on by a thread, and that's the reality. Some of us are unfortunately dealing with sickness in our family, or reduced access, or people that are scared to manage their health in the other ways that they would in normal times. So we've got all of those kinds of complexities in front of us. But the other group that we're very worried about is people who didn't necessarily have to take full advantage of the deferrals, but did. And so this is another group that we're honing in on in terms of some of the research that we're thinking about. And what we're worried about is that, the banks, we think that the banks did an amazing job moving very, very fast. We're learning about some of the complexities around the credit scoring agencies trying to keep up with this data. There's a lot of very difficult technology and operational issues that still need to be solved. But there's many things that need to be done to help people who didn't necessarily need that full deferral to now start to back out of it. And that's one of the things that has been one of the areas that we've been starting to study and help banks target those consumers.
So Kelley, some of the biases that you and David were talking about, does everyone have these biases? Do they only come out in times of incredible stress? Like what is it that kind of puts financial blinders on Canadians?
Yeah, that's a really important question. One of the things about behavioral economics is, my longtime friend and our co-founder, Dan Ariely, the book that he's most famous for is called Predictably Irrational. And there's so much, those two words that we can kind of unpack for a second. Okay. So behavioral economics is not making the claim that, everyone is stupid, everyone is impulsive, we're all just constantly irrational. That's not the claim. What it is there's this term, it won a Nobel Prize, partly I think because it's a little complex of a term, but there's this Nobel Prize, and it's something we should all take into consideration. And it's this notion that we are boundedly rational. Boundedly rational. So what that means is, look, we've all got incredible faculties for making good decisions. And that's not what behavioral economics is all about. Behavioral economics is about studying the things that inhibit us from making good decisions. What are those circumstances? Or from following through. Sometimes we make great decisions and then we don't do anything about it. I've made a great decision about cutting back on my sugar. I haven't necessarily done as good a job on following through with that as I would like. So behavioral economics is understanding how we are boundedly rational. So in a way, yes, we're all guilty of these biases. And what's important is we understand the circumstances that kind of contrive against us, that kind of set us up for failure. And so how can we set ourselves up for success, given that we have this bounded rationality?
Yeah,
Thanks for explaining that.
If I could add to that. So I was talking to a group of very senior bankers at a particular bank. These were all C-level people in risk management and credit. And they were talking about, and it hadn't been launched yet, but them launching a mortgage deferral program for their clients. And, the questions were, well, how's this going to affect the bottom line for the bank? And they said, well, it's actually probably good because the interest will capitalize. So our mortgage balances will grow and our interest income will grow. So that's good. And so this could be a good thing. And I said, what's going to happen at the end of 6 months when, the payment holiday is over and some of these people don't qualify? And they said, oh, well, that's 6 months. We'll worry about that then. So, to Kelley's point, it's not just, us normal people. Even the bankers that designed the program were guilty of were falling prey to exactly the same bias thinking, present bias and scarcity mindset. They weren't thinking of the implications either.
And what are the implications of these mortgage deferrals now getting ready to come due? I mean, a lot of the conversation in the media is it going to be extended? And it's like, should that be the conversation? Or should it be how to help Canadians get out of this financial quagmire if they had to take the deferral? And then also, as we know, if you deferred your HST as a small business owner, or your income taxes or your property taxes, all of that, piling on to Canadians this fall, how, if they still don't have their jobs, if they, like how is this going to be managed? Either of you want to jump in on that?
Well, it is the issue, right? So use the example used of income tax. So people did their taxes, maybe they did their taxes in April, expecting they'd have to pay them. And then they found out they didn't have to pay until September. So what did they do with the money? And it comes back to something Kelley said earlier is, did they go, hey, I don't have to pay my taxes till September. It's only April. That's 5 months. Hey, let's take a short vacation. Well, when September comes and the bills due, and you've spent the money on a vacation, that's a big problem. And, I don't know the answer. I know that, within the regulations, there can be an additional 4 months of payment deferrals, and that's sort of an existing normal thing. But I think that they're going to have to be, I think if they do extend it, they're going to have to be much more careful about explaining to people the consequences of, spending the money, not reducing discretionary expenses. And, they're going to have to incorporate behavioral economics into the communication so that people realize, okay, this is a payment holiday, but this doesn't mean that my mortgage is gone forever. And I'm not sure the communications have been effective in doing that. Kelley?
Yeah, that's right. Some of the things that our team has been working on is helping banks implement things like kind of the reverse of impulse spending, but instead helping them do things like make an impulse payment. So people are concerned and they're still afraid of shutting it off. Because that's one thing to do, is to contact your bank and say, I'm ready to re-engage in my payment schedule. But if people are still too hesitant to do that, being able to provide or at least set aside money in an account where you are continuing to kind of make payments, even though they're in a savings account. So this is a way to help maintain that discipline of a repayment schedule without necessarily turning that deferral off, but at least you're helping to ensure that other trade-offs don't get made. Remember what we talked about, the quality of our decision-making right now and our temptation to give in to other forms of spending. So if we're reluctant to turn off that deferral right now, we should still be acting as if we have those bills due and putting them into a frozen form of savings. And then when we go back into the payment schedule, depending on the nature of the debt that you have with this credit card, you can try to now make that payment possibly in full if you've been able to put together enough savings, or make that one-time payment that you might have access to depending on your mortgage, to try to get caught up on that credit. So putting aside as much money, maintaining that current state as possible is one of the things that we think that people can do. Another thing that we've been thinking about is what we called this idea of a yellow notice. We don't, from what we have seen, we don't think that a strong enough push has been made to remind people that it's a payment holiday in a way. But it's not meant to be a fun vacation. This was meant to be a very kind of strict, kind of keep crisis at bay for people. What hasn't been happening is ongoing communication to remind people or to ask people, do you still need the deferral? Are you in a position where you can get back to your full and normal repayment schedule? We haven't seen that kind of action taken. We've seen a much more hands-off approach. And we believe that yellow notices in the form of emails, outbound phone calls, statement inserts, are things that we would like to encourage the bank to do to serve as a reminder for people as best they can to get back onto their payment schedule.
And we also think that the banks really need to do a better job of incorporating behavioral science into the communications. I was a banker for decades and thought my marketing was brilliant. Marketing investment products using 1, 3, 5-year returns with standard deviations and colorful charts. And the average person looked at it and, it looks like a pizza to me. What is it? What am I supposed to do with that? As a banker, I thought it was brilliant. But, studying behavioral science later, I realized that I was sending out incomprehensible garbage to people. And it's not intentional. It's just due to a lack of insight into the way people process information, perceive information, make decisions. And I think the banks really need to start incorporating a lot more behavioral science into the communication. Sending, I like to talk about the 4-page mutual fund fact. It was supposed to be one simple page that people could understand, and I think only lawyers can understand it. And a lot of the communications coming from banks don't have lawyers write your communications to your clients because, even the bank staff don't understand it, let alone the poor customers getting it. They really need to start thinking about what they're saying and how they're saying, and they need to start understanding how people perceive and process information. Because it's, a lot of dry facts aren't going to work. You have to think about the biases Kelley was talking about.
One of the other things that we've been concerned about is the nature of the stigma that people are feeling when it comes to having availed themselves of deferrals. We have many consumers who have had, been lucky and things have worked out well for them financially, that they've never been in this situation where they're experiencing financial duress. And so one of the things that we're concerned about is the impact that has on people's mental health. And this is potentially another crisis that we're facing, is people feeling this level of stigma, and in turn internalizing that in other ways, which is of course something we don't need in our society. One of the things that banks can do to help is to move into using things like testimonials and examples of how other families are managing, in particular how they're managing right now. And that includes both, the pain and the struggle that many people are facing, but also the things that people are doing to make adjustments. So one of the areas where people are making very big adjustments is we're changing our lifestyle. We're changing the nature of our discretionary spending, and there's been great research coming out by organizations like Equifax and MasterCard. They're starting to share their data because they're seeing just massive changes. And as they're sharing that data, we're looking at, it's not just me not going to bars and restaurants and spending money on new clothes and all of that. It's a lot of people. And I see this as an opportunity to kind of have it's been imposed on all of us, but like this Marie Kondo of our, moment of our spending and reevaluating what's actually fundamentally important. So on the one hand, there might be reevaluating our discretionary spending. We're seeing things like on other projects that we're working on is people are cooking at home more. They're spending times with their family doing things like board games instead of other things that cost money. And those are important basic level opportunities we have for rethinking about our spending. But there's also much bigger things being forced upon us, and that's looking at, do I need this house? Do I need this car? And we're being forced to ask those questions not because of, philosophy and minimalist lifestyle and these nice, pontificate, is materialism good for us? And that's nice. And I love it when we do take time to ponder those questions. Those questions are forced upon us right now. Mm-hmm. And it would be a shame if we don't take the opportunity to really fundamentally think about what's important. What are the most important things? And maybe this is the time for me to sell my house. Maybe this is a time for me to think about public transit. Maybe this is a time for me to consider a radical lifestyle change. And while those are very difficult questions, and yeah, it sucks for somebody to have to downgrade their lifestyle, but maybe this is the time to actually revisit and think about those questions and prioritize what's truly important, which is, of course, your health, your mental health, your family's well-being. And none of those other things are worth that kind of stress.
Will this be the end of FOMO for some people, do you think? That they'll realize that there is nothing more important than having that emergency savings account, having I don't know if we'd be having this conversation in the 1980s when interest rates were in the double digits, right? Like incentives drive the market, and it's been incentivized by our government to have a consumer driven market and go into incredible amounts of debt for it. Do you think that people will reevaluate their FOMO?
That's why we need you, Kelley. That's why we need you helping people feel comfortable understanding finances and having the ability to have the language, the technical understanding of personal finance, a safe space to have a conversation about it, to admit that they don't know the way that the financial system works. And some of the things that David and I are thinking about is how banks need to go further in supporting our personal finance leaders, providing that platform, and also incorporating this kind of language into the regular communication. So we're interested in things like testimonials and social proof as a way to help destigmatize that stress that people are feeling. It's more important than ever right now for the banks to be very, very aggressive in how supportive they are of how people are thinking about potentially something as dramatic as a lifestyle change.
Yeah, Kelley,
and are they?
Oh, sorry, go ahead.
Go ahead, David.
Make another observation. Go ahead, Kelley Peters.
Are they? Not nearly enough. Not nearly as, and I don't want to take a look. I don't want to take away from the fact that right now the complexity that the banks are facing operationally, it is extremely difficult. That you can't just change a mortgage system overnight. And I was also in banking for a dozen years. I understand the complexity of that. But certainly on that, there's a lot of room on the innovation side. There's a lot of room on the communication side that could help the banks help their clients through this period, in addition to just getting that deferral implemented.
Yeah, so in that vein, one of the things, Kelley Keehn, that I love about your work is it's so approachable and it's not intimidating. And I can recall an anecdote. It was in one of your books, and you talked about, a financial plan is important, but the way you described it, it's, do I need to go to an expensive coffee shop and buy, a $10 latte every day? That's financial planning. We were doing some work for one of the largest financial institutions in North America, and their challenge was, how do we get more people to do financial plans? And they were talking about big, huge spreadsheets with assets and liabilities and 20 years of income and expenses. And, doing that's about as much fun as going to the dentist. And I talked to them and I said, so why do you think financial plans are important? And they said, well, everyone needs a financial plan so that they can, manage their savings and investing and expenses. And I said, well, that sounds like fun. How many of you have done a financial plan? And none of them around the table had. None of them.
Wow.
The reason is, it's a horrendous experience, right? It's horrible. Whereas what you talked about was just keep track of every day, what's going out, what are you spending your money on? That's a financial plan. And, if banks could be like that sort of an approach, make it simple for people, less intimidating. As the other Kelley said, people are very anxious right now. And, the last thing they need is more anxiety or more guilt. A little bit of license and saying, look, everyone is anxious. Everyone feels, concerned about the future. And you don't need to do a financial plan, but maybe keep track of the nickels and dimes, and the dollars will look after themselves.
Yeah. I totally agree with that. And I worry so much about when there is that cognitive load, when people are in financial dire straits, when there is this shame and embarrassment behind it. That is when people aren't paying attention to the NSF fees, to the, going to the high interest rate payday loans. And I want to go back to something that you said, David, about not realizing that if you keep increasing, especially with these re-advancing mortgages, where, right, you're making the mortgage payment and it allows for an increased amount of line of credit, that you can very quickly exceed your 80% equity. And I find that number shocking, that 2.8 to 4% more that you could be finding, that you could be paying, and not understanding. And I just want to talk about this for a bit. I was at one of your conferences last year that was absolutely brilliant. I was at the very, very end of it. My goodness, I wish I could have been at the whole thing, but I caught Tom Gilovich, and I've stolen in my keynotes a couple of his stories that I think are really illustrate the irrationality that we'll often make. And I'll come back again to why I'm bringing this up about what David said about increasing mortgage equity. But you know the story where he talks about, for example, if you wanted a lamp and it's $50 and somebody taps you on the shoulder, would you go across the street and a block away to go and get that lamp for $25? And you go, yes, of course, it's a 50% savings, right? Whenever I say this in my audiences, everybody nods their head, of course. But then I think the example was, big screen TV. It's like you've been shopping for it. It's $1,150. That same neighbor comes and taps you on the shoulder and says it's across the street and a block away for $1,125. Would you go? And you almost every audience says, of course not. Like I didn't really do the calculation, but that's probably like less than 1%. Why would I go? But it's the same $25. So in a simple situation like that, where we can't really understand the differences between, and I do it all the time. I do it with ice cream and Louis Vuitton purses and justify all kinds of purchases. But I mean, so you might just hear like, oh, really? My mortgage might go up 2.8%, 0.8% to 4%. Well, that's not really a lot, but that could make or break your retirement. So I'll throw that back to you guys. Like, how do we help Canadians understand that, a quarter of a basis point is thousands or tens of thousands of dollars?
I'll add one part of the answer, and I know David's got a lot that he can add to that. One part is we need to think about numbers in absolute terms, not in relative terms. And that's exactly what Tom Gilovich, who wrote this incredible book that I love to shout out, which is Why Smart People Make Dumb Money Mistakes. And I absolutely love that you cited that research, because that's one of my favorite studies about look at these things that people do. And I love to teach that example as well. And it's the same reaction every time. That's the predictable part of our rationality. So that is one of the challenges, is this notion of thinking in percentages versus doing the absolute dollar values. And I know that math can be a real pain, but that's what we need to do. So if everybody just listen and think about the example that Kelley gave. She said if you were willing to go for $25 from store A to store B, under scenario 1, you ought to be willing to go to the store B in scenario 2, because that $25 is $25. Your bank account doesn't care what it was off of or a percentage of. $25 is $25 that you can use for something else. We saw this in another case, in a project that we did studying investor risk appetite. And we saw that people's risk appetite, because this is one of those things like when you're looking at buying a new investment product, the banks have got it's kind of a know your client type requirement, where they need to make sure that they understand the risk appetite of the client that's in front of them. Do they have a big appetite and they're ready, willing, and able to take on something that's got a lot of risk? Or are they more conservative and need to hone in the potential risk, but that also means trading off on some of that upside? So this is a mandatory process that the banks have to do. Well, we saw something really interesting when we actually studied. There's all kinds of really bizarre things that happen when we start to think about risk appetite. Heck, what does that even mean? I mean, I can understand I don't like roller coasters. That kind of risk appetite I can understand. But when it comes to my investment risk appetite, I don't have the same intuition about what my risk appetite is. And it's even harder for a banker to try to read my mind in terms of what that risk appetite is. So one of the things that we found was that when we talk to consumers or investors and we say, are you ready, willing, and able to potentially have an upside of 10% or a downside of 10%, it's very different than when we actually translate that into dollars. Are you ready, willing, and able to lose $1,000 of this investment? You're ready, willing, and able to potentially have $1,000 new that you might not have otherwise had. When we talk to people and present that data in those absolute dollars, it turns out that generally people tend to be more conservative, which seem to reflect a better understanding of the stakes at risk. So having that convert something from percentages into those absolute dollars and then stop and think, hey, what's 25 bucks worth to me? Is 25 bucks worth the 10 minutes of going across the street to the other store that was in that research? Yeah. So convert those percentages into absolute dollars and then pause and think about the implication of your choices for what $25 would be worth to you in any other circumstance. What would you be willing to do?
Yeah, you know, a similar example of what Kelley was talking about. Someone came to me and asked me for advice on their mortgage. And I gave him some advice and talked to him about a week later and said, you know, how'd it go? Did you get the mortgage? He said, yeah, you know, what you said made sense, but I just stuck with the original plan. You know, it was easier. And I said, oh, well, do you know what that's going to cost you? And he's like, oh, it's not much. It's, I don't know, 0.5% or so. It's no big deal. So I just did a quick calculation. I said, oh, brilliant maneuver, my friend. At the end of 5 years, you would have had a car if you'd followed my advice. That 0.5% sounds like nothing. You would have had a car. It wasn't a car. It was 15 grand, but you know, a decent car, decent used car. When it was 0.5%, it was meaningless. When he realized he could have bought a car for his son or daughter, he went, damn, you got to make it really tangible. The other funny, you know, Kelley, I know you've talked about this. You know, 2.5% on your investment portfolio compounded over 30 years will double your portfolio. And that's when people go, you know, you've talked a lot about efficient investing and using less expensive ways of investing. And, you know, a study has come out that has shown that people are still using very expensive means of investing. And they don't look at the management expense ratio on their funds and they say, oh, you know, it's only 2.5%. Over 30 years, your portfolio would double. You'd have twice as much at retirement. So when you express it in dollar terms, it matters. When you call it 2.5%, people's eyes glaze over.
Yeah, and that's a really great point. I have to admit, too, that a lot of times when I've dealt with my financial professionals, I mean, I was one many, many years ago, I'm an educator now. If my portfolio was down, they usually would tell me in a percentage. If my portfolio was up, they would tell me in a dollar. Wow, look how much this up. Oh, it's only down, you know, 3.5%. Don't worry about it. So those tactics are used against consumers as well when they don't realize it, right?
Yeah. Either, you know, explicitly or just out of habit. You know, they may not be doing that with an understanding of the science, but they're certainly doing it with a long experience of how people react to dollar losses.
Yeah. So we're kind of winding up. I want to ask you another big question, make sure that we don't miss it. You gave us some great advice on what the banks could be doing and should be doing. I hope that they'll be listening to this and reaching out to you for ways to do it, because you're absolutely right. It is the communication. And in a time of stress, people just do not have that capacity to try to understand and navigate jargon. And I love, Kelley, what you were saying about giving people the license to see what other people are doing and that it's okay. That it's okay that, you know, you're not able to do everything for your kids and your family right now, and that's just fine. I want to talk about maybe just some concrete things that people, going back again, David, to you talking about present bias and Kelley walking us through some biases as well, is really not being able to connect to your future self, and the fact that our brain actually dims down when we think about our future self. Do you feel that there's enough understood about this, that the financial industry is doing enough to help people connect to their future selves? Because why would I give up my Starbucks coffee to a stranger on the subway? I wouldn't do that, right? I want that instant gratification right now, but that subway on that stranger on the subway is me 5 or 10 years from now if I haven't actually connected to myself. Do you have any tips and strategies for how people actually do that so they can delay some gratification for their future selves?
Yeah, there's some crucial lessons in here. We can actually look to work that's been done in neuroscience, where people's brains have been studied in fMRIs. And one of the discoveries is that when we think about our future selves, we actually don't have any more empathy for the future version of who we are than we do a stranger. So while there might be some compassion for a stranger, you know, it's at a different level than generally it is for our own self-interest and self-preservation. But it turns out that version of our future selves, we don't really care about that person. And that means we make those trade-offs for ourselves today, not for our future selves, which might need that thing even more. And we discount the value of that need, which unfortunately means that we make trade-offs for things that actually have a lower benefit to us in the long run. So we need to think about and make a stronger connection to our future selves. And so I think there's two things that we need to think about. First of all, let's talk about COVID-19 and this pandemic. This is a long haul. We get information from leading scientists that say we're going to be enduring this maybe for another a year, maybe sometimes I've even heard forecasts that take us to 2 years. It's a long haul. That's a lot for us to be managing. But it will end. You know, the pandemic of 1918 ended. It was just history. We've gone through very, very difficult periods that affected everyone on the planet, and we've gotten through it. So we need to recognize that we're going to get through this. And so, yes, some of the choices that you are making right now in your life are incredibly difficult, but we're going to get through it. So that's the first thing as a message from our future self that we need to keep in mind, or if we look back at history, that's going to tell us that we're going to get through this. Then the second thing, and it's a funny little task, is to just write a letter from our future selves. We don't do this kind of thing nearly enough. And I know that there are the people who listen who are probably the great folks who keep the journal. Turns out there's incredible research on the power of this writing journals. Everything from letting us review our decisions in the past and starting to see the little quirky patterns that we have, sometimes for better and for worse, helps us see ourselves a little bit better, helps us understand what the criteria were that we had when we were making a decision, lets us see sometimes things like we make a mountain out of a molehill, a little expression there, we can see that through our journals. Well, this exercise of writing a letter from our future selves about what's important today is one of the things that we can do to help us make a more calculated and reasoned decision. So take some time. Imagine that, it is 10 years from now. What would you tell yourself? And if that exercise is hard, maybe imagine that you're writing a letter to a young adult, someone who's 20 years old, and you want to give them some life advice. And so think about writing that advice for someone else, and then actually imagine that letter is for you. Those are some things that might help people make better trade-off decisions for today and be more sensitive to their long-term future needs.
Yeah, in terms of better trade-off decisions that Kelley's talking about, it's really just forcing yourself to be a little bit more rational. Jerry Seinfeld had a comedy bit on this, talking about night guy, morning guy, and day guy. And night guy stays streaming videos, right? And 1 o'clock comes around, and who's done this? Everyone's done this. 1 o'clock, I'll watch one more. And then you wake up the next morning and say, damn, why did I do that? Write yourself a letter at midnight that says, dear morning person, I really didn't care that you're going to be tired and hate that you stayed up all night because I'm watching this movie. Please don't blame me. And then you go, yeah, I'll go to bed.
I love it.
Financial decisions are the same way. Think about telling your future self, I decided to take this huge cruise in my 30s, and I know you could have taken 10 cruises in retirement, but I don't care. And that's when you go, huh.
Yeah, and I absolutely get that, and it's totally logical. I wonder, and I believe that Eldar Shafir, and I can't remember his co-author in the book, Scarcity.
Yes, Senko Mullainathan. Yeah. Yes,
wonderful, wonderful book. And I remember, and I'm pretty sure it was in their book. I worry about parents because, they maybe get those CERB dollars in. They have those dollars from mortgage deferrals, and I believe it was research in that book talking about, those on really thin incomes. Why did they then go and buy a big screen TV they can't afford and go and do these things? Like, why would you do that when you can't afford that? And it was actually very logical because it was like, this was their opportunity to splurge, to, rectify things, kind of like the Christmas for kids kind of syndrome. So how do we help parents as well, help them have the conversation with their kids and the family that this will be over? And, is it just introducing things like board games and being more creative? Because I don't know about you, but we've all been in the finance industry for a long time. And it's funny because most of the time, not always, people that have money, they don't feel that guilt. They don't mind playing the board game. Whereas if you don't have money and you have to play the board game, there's a very different mindset behind that, right? So how do you maybe help people who are really struggling delay the gratification for their kids and have that conversation?
Yeah, that shows up in a lot of different ways. We also see that in some of the food research that we've done, where families who are struggling with income actually tend to have wasteful spending behavior when it comes to food that's prepared with a high amount of food waste. And there's this desire to be able to provide, and that's where it's coming from, that place of trying to overcome and create this sense of surplus and to try to push back and hold back that lack of resources. And I think this is where we need to start to break through and help people who are of lower economic status find other means to find a connection to family, to engage in better planning tools, and also to have a more honest understanding of the struggles that other people are facing, and that we don't need to create that facade of spending money that we don't have. We need to connect with the things that genuinely matter. And it's not about a show of money. It's about being in a healthy space where you've got that money, leave that money in the bank, don't spend it if you don't have it, and instead have less stress and find other ways to connect to your loved ones.
That's great advice.
We often project our desires on others, so we assume that our kids want a big screen TV, but a lot of times our kids just want to spend time with us. And, if you ask them what they want, they don't want a big screen TV. We want a big screen TV because they'll love the big screen TV, but they really just want to spend time with us. I remember talking to one guy, his job was tasting dog food. Like the actual dog food out of a can. And his big complaint was that humans buy dog food that appears palatable to humans, but it may not necessarily be palatable to dogs. And it sounds bizarre, but he said the dog food that he liked the most, the dogs didn't like. And the food that he didn't like, they liked. And so, we project our preferences onto our pets. With kids, we project our desires onto the kids, and we rationalize it saying, well, I bought the big screen TV or I took the vacation because my kids wanted to. I think Kelley's advice about experience and really connecting personally and emotionally is probably a lot more important than acquiring a lot of, I just moved recently and I wonder why I bought a bunch of the stuff I bought.
Yeah, that's really sage advice. And if there's any silver lining to this pandemic, I think it's that things don't matter as much as a hug from a senior in our life and a Zoom call with an old friend that you haven't seen. Like, hopefully this is the end of FOMO. But this has flown by, guys. We just have like a couple of minutes left before I let you go. I've taken copious notes. I know everyone watching has taken so much away from this. Can you leave us with how to get in touch with you, the research paper I believe that you're working on with Equifax, if there's any upcoming events that you have, and how we can just stay in touch with you?
That's right. I think we've put together an infographic that's got a little bit of information on it for your audience. And this is, it's got our email address in it, but our URL is beworks.com, and we're regularly putting information there, as well as on our Twitter and on our LinkedIn page. And we're very excited about sharing our research with anyone in this audience who is interested. So please don't hesitate to share your ideas or questions or comments with us.
Marvelous. David, any closing remarks?
No, I couldn't add anything to that. I think personally, I want to thank you, Kelley, for giving us this opportunity to talk about this issue. We think it's important. We think it's important for Canadians, and the more opportunity we have to get people, thinking carefully and not panicking, I think this is a great opportunity to start to get that message out, and I thank you for that opportunity.
Well, I thank you both so much. Kelley Peters, David Lewis from BEworks. Thank you both so much. So much great information here. And remember to go to the link, kelleykeehn.com/blog. All the resources that we've been talking about will be up there later today or tomorrow. And until next time, we will see you on the next Talk Money to Me. Thanks, Kelley. Thanks, David.
Thank you.